Welcome back to Talk Tickers. Today, we're digging into Swire Properties, and their latest results for the first half of 2025 are, well, a real head-scratcher. On the surface, the numbers seem to tell two completely different stories. So let's dive in and figure out what's really going on. So here's the big contradiction, right on your screen. On the one hand, Swire posted a reported net loss of 1.2 billion Hong Kong dollars. That's its first interim loss in over a decade. Now, this was mostly driven by what they call fair value hits on their properties. That's basically just paper losses from valuers marking down prices. But then, you look at what analysts really care about, the underlying profit, and that's up a whopping 15% year over year.
So, what gives? Was this a good half or a bad one? Even the market couldn't seem to make up its mind. The day after the announcement, the stock basically went. So, what gives? Was this a good half or a bad one? Even the market couldn't seem to make up its mind. The day after the announcement, the stock basically went. Nowhere. It closed flat. That kind of price action tells you everything. The story here is complicated. And that's exactly what we're here to do. Unpack this puzzle. Okay, the key to this whole thing, the secret sauce, if you will, is a strategy called capital recycling. This is how a company like Swire can post a big reported loss, but at the same time, generate strong profits and, crucially, fund its future. Think of it like this. They sell off older, more mature assets and then plow that cash right back into their next wave of high-growth projects. And we're not talking about small change here. Look at this number, 6 billion Hong Kong dollars. That's how much cash they generated in just the first half of the year, almost all of it from selling off their big retail center down in Miami, the Brickell City Centre. So let's just quickly walk through how this engine actually works. Step 1, they sell something like those Miami assets.
That sale locks in a real profit on their books, which is what pumps up that underlying profit number we saw earlier. Step 2, boom, they get a massive pile of cash. And step 3, they turn right around and reinvest that cash into their huge growth plan for their core markets back in Hong Kong and mainland China. It's a brilliant, self-funding loop. All right, so that's the big picture financial strategy. But now, let's get into the nitty-gritty. How is the actual business performing day to day? Because when you peel back the onion here, you find a tale of two very different markets, and this explains why their recurring profit actually dipped a bit. And this table just lays it all out perfectly. Look at Hong Kong's office rental income, down 5%. The market there is just plain soft right now, mostly due to too much supply. But then, you flip over to mainland China, and it's a different story. Retail income is holding up, even ticking up 1%. And here's the real kicker. The valuation of that retail portfolio is up 4%. That tells you exactly where the smart money sees future growth. So, with the Hong Kong office market so weak, how is Swire managing? Well, management has a very clear strategy, and it's all about the flight to quality. The idea is simple. When the market is soft, companies don't just want any old office space. They want the best space. They're upgrading to premium locations with great amenities and top-tier green credentials. And that, right there, is Swire's bread and butter. It's how they're keeping their best properties, like Pacific Place, humming along. Right, so all of this feeds into the bigger picture. We're not just talking about getting through the next quarter. We're talking about Swire's massive, long-term bet on the future. They are absolutely playing the long game here, with a plan that's set to completely transform the company over the next decade. And when I say massive, I mean it. $67 billion. That's how much of their huge $100 billion investment plan is already committed. So this isn't some pie-in-the-sky idea. It's a funded, concrete roadmap. And remember that capital recycling engine we talked about? This is what's fueling it. So what does that $67 billion actually buy you? Well, the pipeline is absolutely stacked. We've got major projects finishing up soon. We've got huge upgrades to their malls in Shanghai, Beijing, and Guangzhou happening over the next couple of years. But the real headline, the big, bold goal, is this. They plan to double their footprint in mainland China by 2032. That's an unmistakable signal about where they see their future. Okay, so we've broken down the results, and we've looked at the long-term plan. Now for the part you've been waiting for, the next call. What do we, as analysts, need to watch for next? What are the catalysts, what are the risks, and what's the potential trade? All right, so here's what should be on your dashboard. For potential upside, the catalysts, we're keeping a very close eye on pre-sales for their big residential project in Shanghai. That's a huge one. And of course, any sign of life in the Hong Kong office leasing market would be welcome news. On the flip side, the watch items, the risks, are really macro. Hong Kong office vacancy is still a major overhang, and we all know how important mainland consumer sentiment is right now. And of course, interest rates are always a factor. Okay, let's put it all together. Time to talk about the trade idea. But first, we have to look at this chart. Context is everything here. Swire has absolutely crushed the broader market recently. I mean, it's up 22% in 3 months versus just over 5% for the Hang Seng Index. That is a huge run, and it means that a lot of the good news, a lot of the optimism about their strategy is probably already baked into the stock price. So, where does that leave us? Our call is a market perform rating with a price target of 2350 Hong Kong dollars. Look, the long-term story is solid. We like the capital recycling. We like the big pivot to China. But after that huge run-up, and with the Hong Kong office market still struggling, we just don't see a ton of upside in the short term. So the trade idea? If you already own the stock, you might consider selling some out-of-the-money covered calls. It's a strategy to generate a little extra income while you wait for those big development catalysts to kick in. Really, the whole story boils down to one question. Can Swire's long-term China bet overcome the short-term drag from its Hong Kong home turf? And as always, a final and very important reminder, this is not financial advice. All investment decisions carry risk and should always be made with professional guidance.